Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Thursday, Friday Eve, as they call it. It's November 2nd. The market's not going to gear up to open for about an hour and 45 minutes to be specific with you. And I like to be very, very specific with you. Now, I want you guys to know that a lot of folks ask me, Roger, how come you're putting less trades on right now? Well, Fed, Apple earnings. Look what we got on the docket today. Apple, Palantir, Square, Coin, Shop, Moderna, oy vey, Gold, Lilly, Starbucks, COP. I mean, we're going broad. So we got to be very, 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 very careful. And then with the Fed yesterday, he could say one wrong word and turn the market on the dime. So I wanted to be careful because I'd rather protect you from losing money than help you make money when the trading environment is telling us that there's a low probability trading environment. And we don't want to trade in low probability trading environments. And I'm trying to keep you on the right side of the market, especially when you have the biggest earnings day in history like today. So we got to be really, really careful. Another thing to keep in mind, we may be using wider stops if we day trade today because we have a lot of volatility with all of these earnings. So when you have earnings, you can't have your cake and eat it too. You're going to have a lot of volatility, which gives you the opportunity to make more money, but it also takes away some of that edge that you have in terms of risk. So you got to watch your risk more carefully. You have to watch your position size. I created an ATR video that I posted in your members areas and on the Telegram channel. And by the way, if you haven't subscribed to my Telegram channel, you're totally missing out. You're missing the boat completely. We've had over 130 trades with I think a 93 or a 94% win rate in the last couple of months, and I've given them for free until now. Subscribe to my Telegram channel. Go to rogerscott.com/Telegram, and I'll see you in my VIP room today at 11 a.m. Remember, it's Thursday, so today we're a little earlier, which is good because I'll have an opportunity to do more trading. All right, so let's talk about, aside from Apple, Palantir, Square, Coin, Shopify, we've got a lot of earnings. Now, some of these stocks are coming out before the opening bell, and some of these stocks are coming out after the opening bell. But the key is you want to watch Apple very, very, very closely today. Very, very closely today. It closed near the high yesterday. This is the Hakanashi. Let me put that here. It closed near a swing high yesterday. It's almost at the 50-day moving average. We're going to have to watch it very, very closely. If we pop through the 50-day moving average, we're going to see some upside. Some other notes that I want to show you. Look at Amazon. Above the 50-day line, looks like it wants to go higher. Look at NVIDIA. Almost at the 50-day line, above the 8-day line, looks like it wants to go higher. Look at Netflix, actually, interestingly enough. Netflix crossed the 100-day line, above the 50-day line, looks like it wants to go higher. So you've got a lot of stocks, a lot of tech stocks that look like they want to go higher. Matter of fact, if you look at the QQQ right here, you will see that it's trying to get close to the 50-day moving average. And the SPY, well, there's something interesting here. We're above the 200-day moving average. That's big. That's big, big, big. So we could see very strong buying pressure coming in today, but we got to be very careful because we're going to have very sharp pullbacks. So we can't keep our stops very, very tight. But I wanted to show you that things are starting to look better. Now, the question is, Roger, why didn't you start buying right here? You called this bottom literally within a tick, right? I mean, remember this? We called this. I mean, look at that. We called it. Why did you wait? Well, because we were trading below the 200-day moving average, because none of the tech stocks were making 20-day highs or 50-day highs. They take time to get above here, and we need confirmation. I'm not concerned about being too late for the party. That's not my main concern. My main concern is I don't want to be too early for the party. So I'd rather wait for confirmation before going in. So I hope that teaches you a good lesson today. You sit on your hands, be patient, wait for the market to show its hand. But again, with all of these earnings today, I mean, these are some big, and the thing is, they're not just big stocks, they're influential stocks in their sector. For example, Starbucks, big consumer discretionary stock. COP, big energy stock. Where was the Coin? Bitcoin. Apple, the biggest company in the world, I think, or is it Tesla now? I'm not sure. I can't keep track, but you know what I'm talking about. Net. Lilly, you got healthcare. you got Moderna, you got gold. So you have a lot of leaders in their space reporting today. So if the market moves, it could really, really move. Let's talk about global economy, tie everything together. I obviously have a bullish bias today. Now, interestingly, we've been going primarily short for the last 2 weeks straight. 2 weeks straight. And almost every trade has been a winner, but it's starting to look like the bulls are gaining a little bit of control. Now, the question right now is this a cover? Did we cover our shorts ahead of the FOMC? Did the shorts panic and cover their shorts and take profit from this run up here? Or is this the real deal? Well, up till now, I thought this was short covering, but now, especially with volume, I think we may have a chance to run back up to the upper side of the channel. And if this channel holds, we'll still be in a downtrend, but we'll have a couple of up days. It was better for me to explain this in a video than try to explain this in my Telegram channel yesterday. It wouldn't have gone as well. So market participants waited the peak of the Federal Reserve historic tightening campaign. Powell said, we may be here for a while longer. And the problem is we don't know how long they'll stay elevated. That's not priced into the market at this point. We're looking ahead at Apple for earnings, okay? As widely expected, they kept its rate at the same for the second consecutive meeting and the third time this year. The committee said in a post-meeting statement, tightening financial credit conditions for household and businesses are like to wait on economic activity, hiring, and inflation. And they have been. In the post-monetary policy meeting, Federal Chair Squirrely, a.k.a. Powell, stated officials are proceeding carefully without ruling out the possibility of another rate hike. He emphasized that the Fed is not currently discussing rate cuts. That's not going to happen for quite some time. And I think they're going to wait because the bond market's doing a lot of their work for them, but I think they're going to wait till January. I think they want to see if we're going to have a nice end-of-year rally. I think that's really a big key right now. Benchmark, Nasdaq and the S&P 500 posted a 1-week high. The Dow posted a 1.5-week high. Nothing to get too excited about just yet. AMD did really well, surged more than 9%. Congratulations. ADP, we were short the stock. Well, no, we weren't short the stock, but I told folks in my VIP room this was a good stock to short yesterday, day trade. If you held it overnight, I think you'll get a chance to get out. But if you day traded it and held it for another 20 minutes, half an hour after I told you about it, you should have done pretty well on it. The employment report on Wednesday showed that private payroll rose by 113,000 jobs, weaker than expected. Now, that's the first time I think they had a weaker than expected, but the main report is going to be tomorrow, and we'll see how it really jugs the market. October ISM manufacturing unexpectedly fell. JOLTS job openings rose to a 4-month high. That means there's more job openings. The more job openings you have, the easier it is for employees to negotiate their rate, their what they're going to get paid if there's a lot of job openings. So this could be looked down as a negative thing because if you have too many job openings, that means employees can ask for more money. And if employees can ask for more money, that means it's inflationary, right? Job openings. The more job openings you have, the more employees are in control. Very, 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 very simple. The less job openings you have, the more employers are in control, and employers are not going to raise wages. So the more job openings you have, the more it gives the control to the employee, and if it gives the control to the employee, that's inflationary. Just want to make sure you understand that. U.S. Treasury latest quarterly refund announcement showed Wednesday a deceleration in the pace of increased long-term debt sales. Interesting. Third quarter earnings are here. Apple, Lilly, Starbucks, Booking. I didn't even count bookings. And Shopify, very big consumer discretionary stock similar to Amazon. They're now looking at the S&P to be up 5%. About 2 weeks ago, they were looking at 1.7, 1.6, 1.8. Now they're at 5, and the market finally starting to react. We got jobless claims today. It's going to be a nothing burger. The number has been extremely positive all year, even through this nasty period we've seen. It hovered up to about 275, and then it went straight down. So jobless claims are not looking. There's not a lot of jobless claims right now. Employment is doing pretty well right now. We're going to focus on unit labor costs. That's something that the Fed actually takes into account. We've got factory orders data today. In Europe, they're up, digesting upbeat earning reports. Also hoping that the Federal Reserve rate hiking cycle is over. Real estate and technology stocks led the advance in Thursday. That's very interest rate sensitive. Usually real estate goes up and tech goes up when interest rates are going down. So just to give you some perspective, China closed lower, taking away our tailwind. They maintained a degree of caution due to concerns about fragile economic recovery. A string of purchaser managers index readings this week have indicated that China's manufacturing contracted in October, casting doubts on the possibility of an economic recovery this year. I could have told you the same you don't need to be an analyst to know that. They're really doing bad. Remember, they've been in COVID a lot longer than we have. Japan closed higher again, driven by expectations that the Federal Reserve monetary tightening cycling coming to an end. They should take lessons from us here and potentially peak in U.S. yield. Chip-related stocks were the top gainers, and we may see that here across the board today because I'm seeing a good indication that we may have some strong buying pressure. Sectors. Now, this is going to really screw you up. So look at it the last 5 days. I mean, this is so out of whack. Let's see here. Home builders, real estate. Okay, they've been moving up. That's great. Semiconductors, consumer discretionary. Just in the last few days. Technology. All of these were at the bottom. QQQ, now they're starting to get to the top. Interest rate sensitive stocks are moving higher. But over the last 3 weeks, look where semiconductors are. Look where the Russell is. Look where the consumer discretionary. Look where home builders are. So we're seeing a major shift in sectors. You're seeing defensive sectors leading over the last 3 weeks. And now chip stocks, consumer discretionary, technology, QQQ, home builders, real estate. These move up when interest rates are going down. Home builders and real estate do not like higher interest rates. So this is giving us an indication that we may be seeing another bull run today, and we have to keep our powder dry to the short side. We may start seeing a rally in tech. And if we start seeing a rally in tech, this could drive the market substantially higher. Now, before I let you go, let's look at ETFs. Today's Thursday, and I give you the top ETF on Thursday. I'm going to tell you something right now. Based on what I'm seeing right now, I would actually, here's what I would do. Here is what I would do. I would take a position in, I would do the following. I would take a position in consumer discretionary. I think consumer discretionary is going to have a run-up, and I think chips are going to have another run-up. These two right here. Let me give you SMH. And by the way, if you don't see a rally by the end of today, maybe tomorrow, you don't want to be in this stock. You don't want to be in this asset, okay? But I think we're going to try to hit the 200-day, the 50 and the 100-day line. I think it's going to come up. You can also go just straight up QQQ. The QQQ is not gonna ruin it for you. But here, let me give you both. Here's QQQ. How about this? Expiring in 4 days. You don't need more than 4 days for this. You really don't. You need like 2 days for this. You need today and tomorrow. How about 355 or 354 right here? Okay? You don't need more than 4 days. And let's do SMH because I'm starting to get a little bullish here. Okay, we'll go 8 days out. Perfect. And we'll go to right here, 141.50 or 141. These two right here. Now, folks, here's the deal. If they don't start, if these things, if SMH and if Apple close on their lows today, if this momentum you're seeing dries out right here, then you don't want to be in these assets, okay? I think this is going to continue. I think we're going to see some love and momentum in the tech sector today. I think we're going to get the short squeezing further. So I think we'll see some upside. Be very, very careful. Wait for the first half hour before you go long. Watch your ATR so that your positions are balanced. I got to watch out for you. Now, folks, before I let you go, I was thrilled to announce the launch of the Pro Trader Dashboard this week. And I'm literally over the moon. Yes, over the moon about its reception. It's been an amazing success story. It is an amazing success story. Now, since this summer, I've been leveraging this tool. And the results, they've been fantastic. I don't have to prove to you whether it works or not because I've been giving you free trades up the wazoo with it, like 130, 140 trades. Now, this is a no run-of-the-mill indicator scanner, not even close. It might seem like there's a lot to take in at first glance, but trust me, It's incredibly straightforward, easy to use, and it keeps you on the right side of the market. It keeps you away from doing stupid things because of the way it's built. It only targets you and focuses you into things that are actually moving. First, I start the trading day at 10 a.m. after giving the market 30 minutes to start on the open. This allows the dashboard to calculate the stock's average movement for the first half hour and give me a good entry level. They then simply run a scan to the top stock of the day. Keep an eye out for the lots of greens, red arrows, depending on which direction you go to. And there you go, to the signal for when to jump in and out of trades. It's easy. It's effortless. Next Monday, Tuesday, and Thursday, I'm going to have three-hour getting started sessions on it, okay? And it'll be recorded. It'll be put in your members area. If you have any questions, you can ask Matt, my assistant. Give him a shout out at matt@rogerscott.com. He'll help you install it. And here's the kicker. It even pinpoints first and second profit targets. Say goodbye to the days of trading in the dark. I know you're eager to dive in, so click the link below to discover more, and I'll see you guys soon. Reach out to me, roger@rogerscott.com. I don't bite. And keep your eye on the Telegram channel. Go to rogerscott.com/Telegram. Sign up now. Don't delay. Post questions below this video, and I'll talk to you soon. Bye. Have a great day, everyone.